Hello folks, I'm continuing the conversation where I'm going to discuss the relationship between bonds, stocks, interest rates, and how all these dynamics play an important role in our financial decisions, our investment decisions. And the question here is, have you ever wondered what bonds really are, why their prices move opposite to yields, and how a simple interest rate cut can suddenly push the stock market up? This is going to be a very informative session, so please watch till the end. Knowledge is everything, and this information can go with you for a very long time. Today I'll explain with very simple examples. There will be no jargons and there will be hopefully no confusion. What are bonds? A bond is basically a loan you give to a government or a company. In return, they promise two things. Pay you interest every year, called a coupon, and number two, give you your original money back at the end, called maturity. So for example, you buy a $1,000 bond that pays 5% interest. That means you receive $50 every year until the bond matures. Bonds are generally safer than stocks because you're lending, not owning. What is the connection between bond price and yield? This is an important aspect of understanding bonds. This is where most people get confused. So let's keep it really very simple. Please keep watching. Imagine you already own that bond paying 5%. Then the central bank cuts interest rates and new bonds now pay only 3%. Suddenly, your 5% bond looks amazing. Everyone wants it. So the price of your bond goes up. But your coupon stays the same, still at $50. So even though the price rises, the yield, your return, actually falls. Example, your bond price goes from $1,000 to $1,250, but it still pays $50 coupon. Yield therefore is 50 divided by 1250, which is equal to 4%. That is why the relationship works like a seesaw. When price rises of bonds, yields fall. When price falls, yields rise. What is the connection of bonds and stocks? Important question. Bonds, we are lending money with a steady interest and they're generally safer. Stocks, we're being part of a company, we're earning dividends, we get growth, it's more risky, but the reward is definitely more. Think of it this way. A bond is like renting out your money. A stock is like becoming a partner in a business. How rate cut affects investor decisions. And this is what is important for us to understand. When the central bank cuts the interest rates, new bonds offer lower returns. Old, higher interest bonds become more valuable. Price rises, yields fall. Now, investors face a choice. Do I accept a lower return in bonds or do I look elsewhere? Most people choose stocks, real estate, corporate investments, high yield opportunities, and there is a lot there to choose from. This movement of money can quietly push the stock market up. That is important to realize. So remember the chain reaction. Interest rates fall, bond yields fall, investors shift to stocks, and that often gives rise to the stock market. Simple mechanics with big consequences. If you enjoyed this breakdown, please hit like, drop a comment, and subscribe for more Money Made Simple content. Thank you, and I wish you well.